Business now. It is in fact all eyes on China today with the release of key economic data on the performance in the first quarter. According to the National Bureau of Statistics, China's GDP growth continued to slow to 6.1% in the first quarter. But other data are rather more positive. They could in fact point to a return to stability for this economy. Liu Ying with our top story.
China's economy is slowing. The first quarter 6.1% year-on-year GDP growth rate, down 0.7 percentage points from the previous quarter, and is 4.5 percentage points lower year-on-year. Still, the NBS spokesman says it's not the whole picture.
Positive changes have occurred in our economic situation. The overall performance is better than previously expected.
One positive news is the growth of industrial production has begun to stabilize, a sign of economic activity. Industrial production increased over 8% in March, compared to an average 4% in the first 2 months. Driven by the central government's massive stimulus plan, fixed asset investment in the first quarter surged nearly 30% year-on-year. A similar rise took place in fixed asset investment in March in urban areas. Other positive signs include an acceleration in domestic consumption. Retail sales increased 15% in the January quarter. That's more than 3 percentage points higher year-on-year. CPI, a major gauge of inflation, decreased just over 0.5% in the first quarter. PPI, a measure of inflation in wholesale level, decreased over 4.5%, but with decrease narrowing for 3 consecutive months. China has set a GDP growth rate of 8% for 2009. The spokesman says the economy is still at huge downward pressure and difficulties in meeting the target. Liu Ying, CCTV.
Our headline story today was the release of key economic figures for the first quarter. Let's stay on those figures, but we take a closer look at what they could mean for the Chinese economy in the months ahead. Joining us on the line is Professor Xiao Geng from Tsinghua University. Hello, Professor Xiao.
Hello.
Okay, let's get down to our very first question. The 6.1% figure for GDP growth falls within the range of analyst expectations. Meanwhile, we are seeing some signs of a bottoming out in the quarter with surges in other key indicators such as industrial output and urban fixed asset investment. If we take all this data in its entirety, do you think the worst is over?
Definitely the worst is over for China. But for the outside world, there's still problems. So that's why we will have to rely on domestic investment and the consumption for growth. Yeah. Okay,
all right. So in fact, you're saying if as far as we can rebalance the economy, then the worst is over.
Right.
Well, we continue on that line. If we want to achieve that much desired GDP growth of 8% this year, what are the biggest challenges you see ahead for China?
I think the biggest challenge is actually have to be more efficient in the investment and in the structure adjustment. I guess there should be more reforms like tax cuts. As you can see, the major improvement right now is in the service sector. The industrial sector actually is quite growing slowly. So we actually have a lot of challenges to how to manage in this very big investment and also how to create employment.
All right, thank you. As you just mentioned, reforms and restructuring. Now, this is domestic, I take it. And as you also mentioned earlier, the big thing is to rebalance the Chinese economy away from exports towards domestic consumption. Now, slowing exports, that's not something Chinese authorities can control. Our growth was kept up by the massive fiscal spending plan that was launched in November last year. Now, in the light of the just-out Q1 figures, do you think China at this point requires any more stimulus measures?
I don't think we need more investment in stimulus package, but we probably need some tax cuts because we are not seeing very rapid creation of employment and also GDP growth. We see investment, but not really value added. So that's why I think probably a little bit more push in terms of reform and tax cuts are necessary.
All right, thank you very much indeed for joining us on Biz China, Professor Xiao Geng. Now, that was Professor Geng from Tsinghua University. He gave us his perspective on data just out on how China's economy has performed in the first quarter of this year.
The National Bureau of Statistics says China's GDP growth fell to 6.1% in the first quarter of this year, although it was the lowest in nearly a decade as the global financial crisis has set in, but it's still better than expected. And we're now joined by Professor Liu Baocheng from University of International Business and Economics. Professor Liu, how do you think the data will affect the yearly goal of 8% GDP growth?
Well, I think, as you said, are marginally better than most economists have anticipated for the performance of the first quarter of the Chinese economy, because one is that this 4 trillion stimuli plan is not really unfolded into economic growth yet, because it's still under further definition as how to invest. Second is that the interruption of the Spring Festival is another major issue. And third, because China's economy is largely related to the infrastructure building, so therefore for this cold winter season, the infrastructure has not really started to generate much of the growth.
So we have reasons to be optimistic in some way, but the trade volume has decreased sharply in the first quarter. So do you think the world economy will be affected by this?
Yes. To quite an extent, though, because both our export and import have really slided quite a bit. Actually, it's the worst performance for the last 5 months. But on the other hand, you see that most of the hit would be on the FDIs in China, because FDIs is already taking 12% of the Chinese economy. And also that China is reliant on its export by over 50%. So but in the same time, China's consumer confidence is still there to support this momentum.
So to make up for the trade decline, we have to boost the investment and domestic consumption here. Do you think we need more stimulus packages in the time to come?
Well, of course, on behalf of the industries, yes, they would welcome more and more money to be put into their specific industries. However, I would think that the government would really re-examine how this 10 will take effect, and also try to find some improvement measures. In the meantime, I think the government should support more onto the soft part of the economy, because the quality of the labor needs to be further considered, and also for other training, development, and the support of the infrastructure, as well as the identification of the key cluster would be.
We have to change the mode of growth, so
that's
to speak.
right.
Thank you, Professor Liu. Professor Liu Baocheng from the University of International Business and Economics.